Today we are going to start our discussion with corporate finance. Now, before I start, teaching or talking about corporate finance, I want to see your understanding. Okay, what do you guys know about corporate finance? What insights do you have? What assumptions do you know? What all products do you know? So the floor is open. Anyone who knows what is corporate finance can unmute and speak. Let me ask Kalp to start with. Kalp, any idea? Corporate finance क्या होता है? Guys, the classes are in general interactive. आप हाँ ना बोल सकते हो. It's not like a test exam. कॉलेज का ये कुछ लेक्चर नहीं है. कल आपको क्या लगता है? एनी गेस कॉर्पोरेट फाइनेंस क्या होगा?
To control the expenses of the company.
कंट्रोल एक्सपेंसेस ऑफ अ कंपनी. ओके,
फाइनेंस के रिलेटेड जो भी लेन देन जो भी पैसे का होगा उसको मैनेज भी कैसे करना है और सारी उसकी डिटेल होगी। जैसे पैसे
सर.
आने से लेके उसको मैनेज करने तक उसके फिर एनालाइज करने तक सारा इसमें होगा।
ठीक है. आई थिंक आप कल के सेशन में थे. आई एम गेटिंग सम रेफरेंस फ्रॉम यस्टरडेज डिस्कशन. गुड. ठीक है. सो हियर्स द आइडिया. लेट्स स्टार्ट विद द फर्स्ट वर्ड, दैट इज फाइनेंस. व्हाट इज फाइनेंस? वेल, नथिंग बट योर मनी. But in our context, business context, finance becomes your capital. Money that comes into your business becomes your capital. अभी इन ट्रेडिशनल सेंस में अगर बात करूं, सी वी आर एक्चुअली लर्निंग इकोनॉमिक्स. फाइनेंस है ना, इकोनॉमिक्स का ही ब्रांच है, सबसेट है. So if I talk about where our learning starts, where the concept starts, at the top we have our traditional economics. And what does traditional economics tells us? It tells us that whenever you want to start a business, there are three resources that you need. Let me tell you first two. You guys can tell me the third one. The first resource you need is land. And whenever you use this resource, the cost that you pay for this land is rent. Second is you need labor. And the price that you pay for this resource is wages or salary. Would someone like to try third one? Land, labor, or
Capital.
Capital.
perfect? Perfect. Now we are going in the right direction. You need capital, and the way we kind of compensate, or the price that we pay for this capital, is we have a cost for this capital. और ये cost investor के perspective से होता है return. So capital also comes at a certain cost, and business के लिए जो cost है, investor के लिए वो return होता है. So in this overall section of corporate finance, our focus is going to be this segment. How return mechanism works, how cost mechanism works from business perspective, from investor perspective, risk and return का relation. So in this perspective, let me also double down. एक थोड़ा easier example देता हूँ. Let's say one day, Kalp decides to start a business. Now Kalp had set up his firm, but Kalp doesn't have capital. So what he decides that I will go to an investor. Let's say Kalp decides he will go and meet. We had one more person who answered it, Arush. Let's say Kalp knows Arush is an investor who invests in companies. So he approaches Arush and says, Arush, are you willing to invest in my business? So while this pitch, he will give overall analysis of his business, how we are performing, how we are making profit, and what our growth trajectory looks like. Arush is happy with all this analysis. Arush says, okay, I'm ready to invest. So Arush in return what says? Says what? That looking at your business, I would like to take some ownership in your business. And this ownership can be given through equity shares. What are equity shares? We'll discuss that. But some ownership into this business. And for this ownership, Arush is ready to give some money, some capital that gets invested into Kalp's business. So this is how a typical corporate finance transaction look like. There are two parties to a transaction. First is a business. And business ko in corporate finance terms, we call sell side. Now, why do we call sell side? Because business, whenever they are getting into corporate finance transaction, they want to sell a part of their business. They want to sell certain shares of their business, certain stock of their business. So this is called sell side. And second party are investors. And investors are called as buy side. Why they are called as buy side? Well, by paying or by investing, they are looking to buy certain ownership or certain shares in a business. And not just that, chalo, Kalp doesn't want to sell certain part of his business. He wants to take a loan. So in that case, also Kalp can go to Arush and ask that, can you please give me a loan? And Arush will say, fine, I'm ready to give you a loan. What interest you will give me? So instead of ownership, there can be a lending or borrowing similar to this. So this typically comes under your corporate finance deal. There is a sell side or a business, there is a buy side or investors who get into this deal. So guys, are you crystal clear with the idea of corporate finance? What are we dealing with? Couple of yeses would do. Yes, no? कुछ doubt है? Muskan says yes. Okay, I'm getting couple of yes as votes. Great. Chal, in that case, we can move ahead. So in this section, the first chapter that we are going to learn is called as risk and return. Risk and return. Now, whenever we are using this word return हमेशा investor के perspective से होता है. So now we will be taking up investor's perspective. And please never get confused with this cost of capital or return of capital. एक simple example देता हूँ. See, in this context, we had a business. Now, business is going to Arush, Kalp is going to Arush and selling his company. So Arush will definitely say, I want certain return from this business. I'm investing into you. I need certain return. So Arush says that I'm expecting 20% as return on my investment. Arush says, I'm ready to invest $10,000 in your business, but I have an expectation of 20% return. अभी 10,000 का 20% क्या होगा? It will be $2,000. So this $2,000 is the same amount, but has a different context. If you look from investor's perspective, this amount will be called as return. Or this amount is nothing but a profit for the investors, return for the investors. But think from Kalp's perspective. Kalp is supposed to deliver this to Ayush. तो कल्प के लिए क्या हुआ? Is this a cost or is this a return?
Cost.
Perfect, Muskan. This is nothing but cost. So cost of capital or return on capital, cost of capital or return on investment is one and the same thing. बस perspective अलग है. If you're looking from Kalp's lens, cost हो जाएगा, investor के लिए return हो जाएगा. So now, major focus, assume yourself to be an investor for the coming chapter. Let's start with the first chapter, risk and return. So before starting my explanation, let me ask you guys, what do you guys think would be the relation between risk and return? Would it be जब risk ज्यादा होता है for investor, does he expect more return? Or when the risk is high, does he expect less return? What do you guys think?
More risk, more return. Directly
More risk,
proportional
more
to
More
that
risk, more return.
relationship.
Okay, more risk, more return. This is the correct answer. This is not how it works. But now I have an interesting follow-up question. Can you guys prove me कि जब risk ज्यादा होता है, return ज्यादा रहेगा? How will you prove it to me? What is the logic or what is the theorem type, derivation of this? Because this is where your real learning starts. Why we say that high risk, high return, low risk, low return?
Because
No,
we
ठीक है.
invest more money.
We invest more money. It's a good starting point, but it's not a complete answer. I'll tell you a nice, interesting story behind this. This is not in your books, by the way. थोड़ा extra part है for better understanding. See, there was a gentleman, a Nobel Prize winner in economics. His name was William Sharp. William Sharp. Now, William Sharp was presented with this idea that higher risk, higher return, lower risk, lower return. But William Sharp said, I want to prove it. So let's run an example or let's run an experiment. In this experiment, what he did, he created a chart, he created two axes, and he said on his vertical axis, he will plot return. On horizontal axis, he will plot risk. He called the initial part as low risk. This became low risk. The part in middle was known as moderate risk, and the part at the end became high risk. Now, in this segment, let's say there are three companies presented to you. Okay. This is not based on real data, something that I'm assuming. I'm going to assume Zepto and Swiggy and Zomato are kept in front of you. Over here, you have three options. You have return of, let's say, 5%, you have return of 7%, and you have return of 12%. Now, let me pull out a volunteer and let me ask Ginny in this case. Ginny, if you are given an option to invest, ठीक है, तीन ऑप्शन है आपके पास. You can either invest in Zomato, Swiggy, or Zepto. Where would you invest? All three stocks, all three companies have moderate risk, but they are giving different returns.
Basically मैं higher return पे जाना चाहूंगी because it will have taking a higher risk, but अगर risk ज्यादा होता है तो return ज्यादा ही होता है.
Okay.
It means
So,
that
yes, which company are you choosing in that case?
Zomato. हाँ.
That is actually the right answer. You are sounding less confident, but correct answer. That is spot on.
हम्म.
Zomato, because it's quite logical. Imagine, risk तो same है, Zepto भी moderate risk पे है, Swiggy है, Zomato है, but you are getting 12%, which means if you invest 100 today, Zomato will give you 112, Swiggy will give you 107, and Zepto will give you 105. So obviously you would like to go for a stock that will give you more return. And after this experiment, William Sharp, the economist, he observed when he plots multiple stocks in this sense, multiple companies were plotted. He realized no one was ready to invest in this same risk, low return category. Everyone wanted highest possible return. जो भी सबसे ऊपर है, जो भी सबसे ऊपर है, everyone wanted to invest in this. Why they are investing in this? Because when for same risk you are getting highest possible return, and if your risk is increasing, let's say risk यहाँ पे चला गया, for higher risk, let me use some other company. Let me take example of Uber Eats. Let's say Uber Eats यहाँ पर आ गया. Now you have high risk, but high risk पे same return. Then who would invest in Uber Eats? No one would invest. यहाँ पर भी 12% return मिल रहा है, यहाँ पर भी 12% मिल रहा है. So William Sharp realized that when you have a better option in the market, let's say for higher risk, you are getting higher return. A company with low return would not exist. Why would not exist? No one would invest in it. Imagine that आपकी कंपनी में बहुत ज्यादा रिस्क है, बट रिटर्न का कुछ चांस ही नहीं है. Who would invest in your company? So if no one is ready to invest, would you exist in corporate finance? Would you invest? Would you exist in the market? No. So for a company to exist, for a company to be competitive, this is the principle that they follow. The moment any company feels that their risk is higher, they will immediately come up with a pitch saying that, "Arey, we will deliver high returns." And then only the market will entertain them. Investors will entertain them. The moment they say risk is high but return is low, जैसे यहाँ पर जेप्टो का केस है, the risk is moderate, equal to Swiggy, equal to Zomato, but return is low, no one would entertain Zepto. So Zepto will now immediately will have to go back and increase the return that they will deliver in the market. Everyone clear with the idea? Why high risk, high return? इसका logic क्या है? Okay. Can I
Yes, sir.
get Y's in the chat? Thank you. So we'll follow the voting system. Okay, I'm getting positive votes. In that case, we are good to go ahead. Now that the principle behind risk and return is clear, please make a note of this. Whenever you will face high risk in the market, company is supposed to deliver high return. And whenever there is low risk in the market, company is supposed to deliver low return. Today, we will discuss all about risk, different types of risks. Tomorrow, we will start with calculation of return. Let me now get started with the actual chapter from our overall slides. By the way, you guys will have access to these slides on our LMS. If it's not updated, every batch we kind of keep on updating, making the slides better. These slides are sent to us by Hawk, but we keep on making it better. So अगर uploaded नहीं होगा, let me know. I'll upload it for your batch as well. चलो, first chapter, risk and return. We already know more risk requires more return, less risk requires less return. Now coming to risk, understanding risk. Let me start by asking you guys, what is risk? What do you guys think? Anyone can answer, don't worry. गलत हुआ तो भी ठीक है. Let me ask Sumit. Sumit, would you like to try? What is risk?
The risk is something that we cannot sure about.
Okay. So you are mentioning uncertainty. थोड़ा difference होता है risk and uncertainty में. Anyone else? Let me ask one more person. Tanvi. Tanvi, would you like to try? Just give a guess.
We
गलत
can't
होगा भी.
predict, which we can't predict what will be the result.
Can't predict. Again, going towards uncertainty. So here's the actual definition of risk. See, uncertainty ना दो तरह का हो सकता है. If you can't predict, something good can also happen, something bad can also happen. So we can't label it as something we can't predict, because good stuff is not risk for you. अचानक से सेल बढ़ गया, अचानक से डिमांड बढ़ गया, that is not a risk for you. But coming back, then how would you define risk? See, as a business, when you start now, you always have certain objective. If I, let's say, simplify objective, think of it as a goal, as a target. And whenever you have certain goal, there will be events which will hold you back. Because of these events, you would not be able to reach your goal. You will not be able to meet your target. This event is nothing but a risk for you. Any event, any incident that will hold you back from achieving your objective becomes a risk for you. Now, usually businesses का objective क्या होता है? Those who have studied BCom, what is objective or goal of a business?
You're
Ultimate
making
objective.
profits.
To earn profit.
Profit, ये BCom level answer है, but now you guys are learning CMA. So advanced level actual answer would be objective of
To
any
grow a
business is
business.
wealth maximization. किसका? Wealth maximization of
Shareholder.
Shareholders.
perfect shareholders. And usually this wealth maximization of shareholders happen through profits. So your answer is correct, but not completely. Our overall objective is share wealth maximization होना चाहिए, and profit is one way of delivering that wealth maximization to our shareholders. So most of the times you will see your losses, any cost बढ़ गया unnecessarily, revenue कम हो गया, all gets connected back to your profitability and further to wealth maximization. Now within this risk, we have multiple types of risk. Risk that impacts your business, it's pure risk. It starts with something that is pure risk. आप business start करते हो, by nature of that business, you have certain risk. और उसी के लिए profit मिलता है. So our first starting point is pure risk. That whenever you start a business, by nature of it, any event that will hold you back becomes a risk for you. Now within this, there are ways of taking unnecessary risk as well. यहाँ पे एक word है speculative risk. Let me make it simple for you. What is speculation? Let's start with understanding the word first. Speculation. Speculation simply means that once we don't know what is going to happen in the future, we try to speculate, we will try to predict. And once we predict, let's say the prediction will go in our favor. Let's say we think price will go up. I'll just give you an example. Price will go up in future. So what we do, we increase our inventory. कि जैसे price बढ़ जाएगा, in future we will sell at a higher price. But ये गलत हुआ. Speculative risk. Let's say we predict कि यार future में price कम होगा. So what we did, we started selling our inventory at huge discount ताकि जल्द से जल्द we are able to sell off our inventory. Maybe tomorrow this doesn't happen. So again, this is speculative risk. When you predict something, when you speculate something, speculate मतलब थोड़ा predict करना on uncertainty. That becomes your speculative risk. In our terms, what I'll do is I'll just highlight all the important points. I won't be reading out the whole slides. I'll teach you everything conceptually. But जो भी थोड़ा difficult लगेगा, needs explanation, I'll cover that part in the class. So pure risk we have discussed. In terms of speculative risk, the variability of actual returns from expected returns. मतलब you had certain expectations, you predicted something, but there is difference with actually what happened. So this difference becomes a speculative risk for you. It can result in gain or it can result in loss. Coming to now major types of risk. First, we have something called as financial risk. Financial risk is simply risk of losing money. So you can make a quick note of this. What is financial risk? Risk of losing money. From investor perspective, Let's say you invested in a company and कल वो company closes down, shuts down. It's a complete risk for you. On contrary, why do you invest in a company? Maybe instead of closing down, it grows further, goes for an IPO, and you make huge amount of profits by selling the share. This is your intention, this is your objective, but obviously, if this is not met, there is financial risk for you. Now, within financial risk, you have something called as systematic risk and unsystematic risk. Now, this risk is quite new to you, so let's discuss this in depth. A quick note as well, please be very attentive for next 10-15 minutes, okay? Because systematic and unsystematic risk is a very important topic from exam perspective plus finance perspective. मतलब जो भी expert है in capital markets, they should know this concept by heart. And to understand the concept, let's build a nice case study. So imagine that one day Swaroop decides to invest. He analyzes multiple stocks and he really likes one stock. He thinks that Arey, Tata Motors is in news all the time. Let me invest in this company. There are new models coming up, Tata Sierra, Nexon, वगैरह. EV maybe also they are doing good. So Swaroop decides to invest. Swaroop का spelling गलत हो गया, my bad. So Swaroop, if you invest in this company, what all potential risks do you see? ठीक है, आपने कुछ shares खरीद लिए, 20-30 shares. What all risks do you see?
Sir,
Take a guess. क्या हो सकता है? ठीक है. Let me help you. If Tata Motors tomorrow takes a loan and is not able to pay EMI, do you think this is a risk?
yes, sir.
Okay. Tomorrow, if in tax filing of Tata Motors कुछ गड़बड़ हो गया and now government has a penalty on them, is that a risk for Tata Motors? Yes. Tomorrow, let's say there was a layoff by Tata Motors, employees go to the labor court, and now there is a penalty levied by government on them. Is that a risk to Tata Motors? Yes.
Yes.
So looking at this, Saurabh gets concerned. Kyar, I'm investing in Tata Motors. There are so many risks that Tata Motors face. And he gives them a very nice name. Saurabh says all these are stock specific risk. Stock specific risk. And this is a major concern for me. What should I do? Saurabh starts thinking about it. So Saurabh meets a friend, and that friend tells Saurabh to change his strategy. From stock specific now, Swaroop invests in multiple companies. This time, the number of companies investing are along with Tata Motors. Tata Motors, he decides to invest in Hyundai. Hyundai. He also invests in Maruti Suzuki. He also invests in Mahindra and Mahindra. The automobile segment, Mahindra and Mahindra. And now he's relaxed. Why relaxed? Ki chalo, if there is a loan issue that is happening with Tata Motors, do you think Hyundai will also have same issue? No, not necessarily. Maruti Suzuki will have certain issue. Not necessarily Mahindra will have certain issue. So when Tata Motors is facing, let's say, loan issue, tax filing issue, employee layoff issue, maybe Hyundai will do better, Maruti will do better, Mahindra will do better. Tata is suffering, so competitors will do better. Obvious, right? So Swaroop, now again coming back to you. Potentially, what risks do you see over here?
Sir, uh,
Take a guess. Chalo, let me help you.
low returns or not?
Let's take one more example. Let's say tomorrow government says there are too many vehicles on the ground. Iska GST बढ़ा. GST of all the cars goes up. Do you think it will impact Tata Motors or do you think it will impact all the car companies?
Yes, sir.
All car companies, correct. Tomorrow government says, yeah, petrol is too expensive. Petrol is too affordable. Let's make it expensive. It will impact all car companies. Tomorrow government says, government should. These companies are getting into EVs. Suddenly in the market, you need battery, right? Battery के लिए lithium लगता है. Let's say the cost of lithium goes up. The supply is low, demand is high, prices go up for the battery. Will it impact just Tata Motors or all the companies?
All the
All.
companies.
All the companies, perfect. So again, now Swarup gets concerned and he calls this industry specific risk. Industry specific risk. He started with company specific. He added more companies from the same industry, but now he has one more risk, industry specific risk. So this time, Swarup comes to meet an expert. Let's say Swarup comes and meets me and says, Aditya, how should I invest? And here's my recommendation. If you like Tata Motors, please invest. Let me use a green color. If you like Tata Motors, do invest in Tata Motors. But along with Tata Motors, why don't you invest in Reliance as well? Why don't you invest in Zomato? Zomato is now called Eternal, but why don't you invest in Eternal as well? After this, why don't you invest in Varun Beverages? Do you guys know what this company does?
Pepsi.
Correct. India का पूरा Pepsi supply. Pepsi means your cold drink, soft drink. It comes from Varun Beverages. So this is my recommendation to Swarup. Okay, invest in Tata Motors, invest in Reliance, invest in Eternal, Zomato, or invest in Varun Beverages or Pepsi. Now, when government is increasing GST for cars, do you think Reliance will face that issue or Zomato will suffer because of that? Is that possible? No, not necessary.
No.
If price of lithium goes up, will it impact Varun Beverages? Not necessary. So now, when Varun is managing this, analyzing this, he gets to know this portfolio has become a diversified portfolio. Diversified portfolio. And he observed there is no, it's some glitch with the pad. Huh. And now Swarup observes there is no stock specific risk, there is no industry specific risk. So Varun is happy. But then I step in again to tell Varun that the story is not over. In this case, if government steps in and says income tax of everyone goes up, हर किसी का income tax in India goes up. So everyone will have now less disposable income. Do you think it will impact all the companies? Yes. Next, our economic rate comes up and we get to know that inflation is high right now and is likely to be higher even next year. So inflation as a concern, do you think will just impact Tata Motors or all the companies? What do you think, Swarup? किसको impact करेगा? एक company या सारे companies
For
को?
all the companies.
All the companies, exactly. And this is where the story ends. That when we have a diversified portfolio, we still have certain level of risk with us. Now, what all names we can give these specific types of risk? Here are the names. Whenever you have stock specific risk, or you have industry specific risk, industry specific risk, it is called as, this whole category is called as unsystematic risk. Unsystematic risk. This is our first category major. We started with financial risk, and within financial risk, this is our first category of unsystematic risk. Now, if the investor decides that I will diversify, let me just keep this part separate. Now, if investor decides that he will keep his diversified portfolio in place, he will diversify. He will be able to get rid of stock specific risk, industry specific risk, but there will be one risk that still is pending. This risk is called as market risk. This risk is called as market risk, or in technical terms, this is called as systematic risk. That's it. I'll summarize in one line. Stock specific risk is risk when you invest in only one stock. तो company specific risk आप suffer करोगे. Industry specific risk is a risk when you invest in only one sector or one industry. So anything goes wrong, you will suffer. But when you diversify multiple sectors, multiple stocks, multiple companies, then you suffer only market risk. You are only exposed to market risk. These two risks are called as unsystematic. Market risk is called as systematic. Market risk is a risk that you cannot get rid of. If you invest, you will definitely go through market risk. But yes, there is certain benefit. Benefit kya hoga? See, if Tata Motors goes down, there is a good chance Reliance might go up. If Eternal goes up, maybe Varun Beverages might go down. So diversification kind of optimizes risk. Risk को minimum रख के return को maximize करता है. So that is the benefit of diversifying. I'll write that here as well. Whenever you diversify, it minimizes your risk and at the same time it maximizes your return. That is the benefit of diversification. So now let me take a quick vote. If you guys are crystal clear with the idea of what is unsystematic risk, what is systematic risk, can I get a Y in the chat? There are 20 members in the class. I'm expecting 20 votes. The floor is open for questions as well. किसी को question होगा तो please ask. No questions? Okay, I have almost 80% votes now. So, we are good to go. I have all the votes.
Just a question.
Yes, Sarita.
Since you said diversification minimizes risk and maximizes return, in what kind of scenario would people would still prefer to invest in stock-specific risk or industries, like not diversify but still invest in specific stocks? Such scenarios are going to be there because everyone would
Yes.
prefer to diversify. Yeah.
Yes. So I'll tell you my perspective on this. I studied this almost 10 years ago, okay, during my first certification. And I was very impressed with the idea. Okay, wow, diversification, and my returns are going to skyrocket without any risk. So I still remember back in 2018 when I invested for the first time in my life. 2018, I had shortlisted 10 stocks, ekdam research karke, and best level diversification. Okay. I had invested in Reliance. Then I had invested in something called as Venky's. Okay, it's a poultry farm supply company. I had invested in Pidilite. ठीक है, फेविकॉल पे जो फेविक्विक वगैरह बेचता है, ऐसे I had great analysis and overall diversified, and I observed कि यार एक साल बाद I have just made around 12% return. So my expectations were too high, but everyone said okay, 12% is decent enough. On contrary, so my father also invests in stock market, and he likes to be very aggressive. Aggressive in the sense he won't go and invest into 10 stocks. He will pick only one stock, maximum two stock, but all his capital is into that one stock only. So imagine Reliance, let's say, goes up by 40%. So his overall capital, let's say someone who has invested 100 will get back 140. But imagine I also had $100. I invested maybe 20 over here, maybe 50 in Venky's, and maybe 30 in Pidilite. Reliance goes up by 40%, but maybe Venky's can come down by 20%. And again, Pidilite can go up by 30%. So यहाँ पर ना one stock coming down can also compromise. So again, it goes back to that logic only. In reality, this reduces your risk. But for this reduced risk, the return is said to be maximum, but not maximum in the sense कि बहुत ज़्यादा return मिलेगा. It is optimized. It is not best possible scenario. It is optimized. Minimum possible risk के लिए maximum possible return. That is optimization. But in this case, it's pure risk play. Take maximum possible risk and try to get maximum possible return. So there is, in reality, you will see this happening aggressively. And eventually now I also do this. I don't diversify क्योंकि मुझे ज़्यादा risk चाहिए. Maybe in my late 30s, late 40s, I will try to diversify. But till the time I have, appetite for risk, मैं ज़्यादा से ज़्यादा risk लेके ज़्यादा से ज़्यादा return try करूँगा. Does that help, Sarita?
Yes, very clear. Thank you.
Okay, yes. Okay, chalo. I think we can go back to slides now. First, systematic risk is the risk that all investments are subject to. As we discussed, systematic risk, all companies will face this, market risk. It is caused by factors affecting all assets. Now coming to unsystematic risk. risk specific to a particular company, we called it stock specific risk, or industry, we called it industry specific risk, in which the company operates. So I hope these statements now make sense to you. Now, within systematic risk, we are going one step deeper. What all risk do we face? Let's start analyzing. We started with financial risk. Within financial risk, we are now going to systematic. And within systematic, the first risk that we face is market risk. Let me just confirm. Market risk. Acha, before me starting the explanation, let me ask you guys, any guesses? What is market risk?
I guess there's the demand factor here in the market risk, whether the demand is there or not.
Demand, yes, you are going in the right direction.
Economic condition.
Economic, yes, going in the right direction. But to explain it in a very simple manner, market risk is nothing but if you invest into something, let's say you invested in some company, you put in $100, the risk that your market value comes down, the market value or the value of your investment, comes down is market risk. As simple as that. And whenever you invest, the moment you step into the market, either on buy side or on sell side, you will always face this risk. The only way to get rid of the market risk is leave the market. Kaise? I'll give you an example. Let's say, let me take a volunteer this time. Let's say Simran. Simran decides that currently Reliance looks good for investment. Reliance is currently at, let's say, 1200. Now, after deciding to invest, there's a good chance it will go to 1400. Best, you're happy, you'll be profitable. But there is a risk that your 1200 ka stock price will come down to 800. This part is nothing but your market risk, that the value of your investment will reduce. Now, how to get rid of this risk? Leave the market, sell the shares, and don't participate in the market. Then you do not have any risk. Okay. So, guys, is everyone clear with market risk? Any doubt, any queries? Just one or two guys would do in the chat. Then I'll move ahead. Okay, thank you. Next risk is interest rate risk. So let me just check if there's anything difficult that needs explanation. No. Market movement we have discussed. Under interest rate risk, what happens is, so let me ask a very basic question. Guys, who decides interest rate in a market?
RBI.
Perfect. RBI will decide, looking at overall growth, contraction in the market, basically inflation ko control karna वगैरह. Looking at this, RBI will decide. RBI can decide, yeah, the rate will be 4%. They will decide rate will be 6%, or they'll only decide rate will be 8%. Completely up to them. But what happens when you are in the market? Let's say you are a business. You need to borrow money. Now, today you went to a bank. Let's say you went to SBI, and SBI said, we are ready to give you a loan, a business loan at 12% interest. Just assuming a number. Let's say this business is being run by Sunil. Sunil agrees. It sounds reasonable. Let me borrow at 12%. But what happens after some time, let's say 2 years down the line, 3 years down the line, RBI thinks, the economic condition is not good. We need to promote growth. We need to promote, let's say, more demand in the market. We need to push liquidity in the market. कभी क्या होता है कि if there is too much recession ना, RBI needs to step in just to distribute money, distribute capital, make capital easy and cheap. So RBI says rate जो 12% था, now it will be just 6.5%. Now in this condition, Sunil, how would you feel? Once you borrowed 12% था, but अभी 6.5 हो गया.
It's a favorable one for the business. So because the interest rate has come down, the exposure is minimal.
It is favorable for the businesses who would borrow over here. But let's say you have already taken loan at 12%, and this loan, you cannot prepay, you cannot cancel, and you have to pay for next 10 years. Now, how would you feel?
So then I have to earn more so that I need to pay an additional one. So because others have a competitive edge compared to me.
Yes, others will perfect. Others will get to borrow at 6.5%. You are paying at 12%. It's a risk for you. And this is nothing but interest rate risk. That's it. So let's quickly go through the slide as well. The risk that value of the investment will change over time, resulting from changes in market rate interest. Now, how value of your investment changes because of market rate, that we will learn later on. There is a specific topic on valuation. So once we learn that, you will understand the valuation part. But in general, the moment there is change in market rate, you will face certain risk. One movement will be in your favor, one movement won't be in your favor. In this case, Sunil is a borrower. So in this case, now it looks good. In this case, Sunil is a borrower. For him, whenever the rate goes down, it is a risk for him. But the rate goes up. Let's say RBI says too much inflation in the market. Let's increase the rate to 18%. In that case, Sunil will be happy. But the rate is increasing, he is already paying at a lower interest. So it depends. One part would be favorable, one part would be risk. Longer the maturity, I'll explain this as well. See, if we talk about now maturity, let me create two scenarios. And let me ask this question to Zaid. I'm not sure I'm pronouncing your name correctly. Is it Zaid or Zaid?
Zed.
Zaid, okay. So Zaid, let's say you have two options to invest. You have a 3-year FD option and you have a 7-year FD option. Where would fixed deposit मतलब you go to a bank and you do a fixed deposit. So कहाँ पर ज़्यादा risk लग रहा है आपको?
Risk is minimum in both of the options, as FD is not like any risk. We have no risk in FDs.
ठीक है.
So
I get you.
invest in 3 years FD.
Okay, got it. That is actually spot on. So I could hear half of the part only. There was some noise, but this is what I understood from the partial part. So you mentioned that FD doesn't have much risk, which is spot on. ठीक है, आप nationalized bank में जाते हो, backed by government, minimal risk. We'll discuss why that happens. But within 3 years and 7 years, see the major risk comes in from potential for change in the rate. Currently, if RBI says your FD ka rate is, let's say, 3%. Now this 3% ka rate can go up to maybe 9%. You never know. कुछ हो गया economy में and that needs higher rate. Or this rate can stay back to 3% only. So there is uncertainty. Now if there is potential for change, ये 3 साल में change होगा जल्दी से या धीरे धीरे change होता है? धीरे धीरे change होता है. It takes time for change. So when I'm saying it is moving from 3% to 9%, where it is more probable, 3 साल में जल्दी हो पाएगा या 7 years में हो पाएगा? It is more probable or possible in 7-year scenario. 7 years may, let's say the rate will change from 3 to 4, 4 to 6, 6 to 7, and then 7 to 9%. But if someone had invested in only 3-year rate, so 3% to 4, 4% to maybe 6%, okay, FD mature. So in this risk, if Zayed decides to invest for 3 years, after his investment of 3 years, he can again go back in the market and invest at a higher rate. कि यार जब मैंने इन्वेस्ट किया था, दिस इज हाउ जायद विल थिंक, यार जब मैंने इन्वेस्ट किया था 3% रेट है, लेट मी जस्ट इन्वेस्ट फॉर 3 years. आफ्टर 3 years आई गेट टू सी रेट ऑफ 7%, आई गेट टू सी रेट ऑफ 8%, 9%, आई विल इन्वेस्ट. तो यहाँ पर जायद के रिस्क को क्या हो गया? जायद रिस्क इज लेस इन दिस सिनेरियो. जायद इज एबल टू मैनेज रिस्क एट अ लोअर लेवल. बट इमेजिन Zayed invests at 3% as now is stuck for 7 years. So whatever potential returns he could have earned in the 4th year, 5th year, 6th year, 7th year, all these are gone. So in this case, risk ko kya ho gaya? Zayed is locking his capital for 7 years. It means he's taking higher risk. So now is the concept of maturity clear? This period is called as maturity. जितने period के लिए you are making an investment, for whatever period you are making an investment, that period is called as maturity. So when we have two options, you have 3-year investment option versus you have 7-year investment option. 7-year investment option. Where would you see higher risk? You would see higher risk over here and comparatively lower risk over here. Guys, clear with the concept? Yes, no. Okay, so now this statement will make sense to you. Let me just see if anything needs explanation. Greater interest rate. So longer maturity, greater risk. That's it. Next, we have purchasing power risk. Acha, would someone like to try and explain how inflation will actually create a risk for you? Inflation से क्या होता है actually?
So the increased prices of goods and services.
Increased prices of goods. That's impact of inflation. But yes, you're going in the right direction. So let me double down. If I had to break down now how an economy works, okay, let's spend 5 minutes on this. Then inflation will become very easy to you. An economy goes through a series of changes, a series of cycles rather. ये cycle कैसे start होता है? Think of it in this way. Imagine that one fine day, uh, we decide that our economy is doing really well, but महंगाई बहुत बढ़ गई है. Everything is expensive. In that case, we want interest rate to be interfered. अबे interfere करके क्या करना है हमको? We want to promote savings. There are only two phases in an economy. First is when inflation is too high. Inflation is too high. In that case, promote savings. Why promote savings? I'll come to that. And when inflation is too low, inflation is too low, we promote expenditure or lower rates. Savings, we promote higher rates. अब ये कैसे होता है वो समझ लेते हैं. Let's start with recession. I think that would be an easier scenario to understand. Let's say economy is not doing well. There are very less jobs. There is no capital in the market. Everyone is suffering. So what RBI will do now? RBI will say, "Acha, let me make loan very, very cheap. The loan rate should go down to 2%. This is where the loan rate is. Now, when loan rate is very cheap, what happens? Any small businessman who wanted to start business, he says, "अरे 2% का ही loan है. Let me borrow. Let me borrow." So he starts borrowing. Secondly, let's say I'm a salaried person. I go to the bank and see, अरे बहुत कम interest मिल रहा है savings पे, बहुत कम interest मिल रहा है FD पे, fixed deposit पे. Let's say the savings rate is around 1%, 0.5%, assumed. So when the interest rate is 0.5% or 1%, do you feel like saving? No, you would rather spend. So when customer is ready to spend and business is ready to borrow and grow, what happens? This customer creates a demand in the market. When business borrows, there will be more people who are employed in the market. Let's take very simple example of movie theater. Okay, movie theater shows good statistics around this. If there is low cost capital, okay, cheap capital available in the market, everyone will borrow. Let's say PVR also borrows and opens up more theaters. More theater aa gaye. Secondly, people also want to spend more, so they want to watch more movies. So more people will start going to the theaters. When more people will start going to the theater, average income of, let's say, a theater receptionist or staff within PVR, this average income will go up. When average income of this theater person will go up, while going home, what he will think, "Arey, let me put my kids into better school." So he will start spending more on their school expenditure. When kids go to school, they will have better friends who are going on a trip. So the school will say, "Let us spend more. More admissions are coming in. So we will have even better trips. We will spend more." So एक spiral create होता है. The moment you have lower interest rate in the market, businesses start borrowing more, people start spending more, and there is a demand spiral. Demand बढ़ते जाता है, बढ़ते जाता है, बढ़ते जाता है, बढ़ते जाता है, and it reaches to a point where demand is greater than supply. There is too much money, too much demand in the market, but supply is not up to the mark. Now imagine theater seats are limited, but everyone wants to watch a movie. So what will happen to your ticket price? Any guesses?
Increase
Of
Goes high.
course,
Ticket price
increase.
increase.
And this is nothing but inflation. Mehengai, the prices are going up. Rather, money's purchasing power is reducing. Technically, आपके पैसे की जो power है, the things it could buy, $100 yesterday versus $100 after 1 year, you are not able to buy same amount of things. So that is inflation. हम यहाँ तक पहुंचा था. And at this point, government wakes up or RBI wakes up. RBI says, अरे inflation अब बहुत बढ़ गया है. Everyone is spending too much. There is so much demand in the market, but very less supply. We need to control this. So now what government will do? Government will say, now the interest rate is 12%. Now imagine someone who likes to spend a lot now suddenly sees, are 12% interest. So if we invest 100, we will get 12% in bank only without doing anything. So now this employed person is encouraged to save, encouraged to keep money in fixed deposit. Secondly, the businessman who had an idea, who wants to borrow, he sees that, are 12% pay interest rate. It will be very expensive to borrow. So the businessman would say, no, I don't want to borrow. I will slow down things. PVR will say, I don't want to open more theaters. Capital is very expensive. So when this happens, what happens to demand? Demand starts coming down, coming down, coming down, coming down, coming down. Yeah. And now suddenly there are no jobs, there is no growth, everything is dull. Now again the RBI wakes up and now again they will make changes. So this is nothing but an economic cycle. Nothing but an economic cycle. And whenever businesses operate in an economy, they go through this cycle. They have the risk of this cycle. And one of the risks that they face in this cycle is nothing but your purchasing power risk or inflation level risk. If you have this context, let's read out the point. It will make sense to you now. It's very easy. The risk that purchasing power of a fixed amount of money will decline as a result of increase in general price level. Inflation. Basically, inflation hai, because of that, you are not able to afford things. That's a risk for the business. Imagine earlier with 500 rupees, somewhere around 2010, you could buy 5 tickets aram se, of a very good theater. In 2015, using 500 rupees, you are now able to buy only 3 tickets. Somewhere around 2020, pre-COVID, using 500 rupees, in 2020, you could buy 2 tickets. And in today's time, if you are going to first day, first show of a really good movie in 2025, 26, you would be lucky if you get even 1 ticket. So instead of saying that things are expensive, I mean, of course, things are expensive. That's why number of tickets are reducing. But the technically correct definition is, with the same amount of money, you are now able to buy less items. This is nothing but reduction in purchasing power. Your purchasing power of this 500 rupees has reduced. Earlier, this had power to buy 5 tickets, then 3, then 2, now just 1. So this is your purchasing power risk. Okay. Any doubts? No? Okay. Next, we have foreign exchange risk. Now, as part of the assignment, I had asked you guys to go through Forex 101. Let me just check how many of you have done the assignment. If you have watched Forex 101 from Finance 101, can I get Y in the chat? I just want to confirm how many of you have done the assignment properly. No one has watched. Assignment किसी ने भी नहीं किया. Okay, surprising. Let me reiterate then one more time properly. I mean, you folks are new, कल ही induction हुआ है, so I can understand. Let me just show you what all assignment you guys have to do. See, in your dashboard, you will have this Finance 101 visible at your end. So यहाँ पर, after going inside this module, sorry about that, just let me close this once. Within this module, without fail, please watch all these lectures. This is something that you should have known from your BCom days. इसलिए I don't cover, we will be covering, by the way, most of it from basic. But I want you guys to be prepared properly. So please watch what is finance, what is equity, what is debt, time value of money, acumen. If you want to use calculator, then you can use this session. Accounting 101 भी I'm keeping optional. ये part 1 के लिए थोड़ा relevant है. Forex 101, this without fail, okay? I want you guys to watch it today itself without fail. Forex 101, then risk management and derivatives. Please, without fail, watch all these lectures. Second part of your assignment is simple mathematics. So if you're someone who's studying after a long time, or if you think you need some assistance with basic mathematics, ये 11, 12, 11, 12 भी नहीं, 8, 9, 10 standard का है, please watch this as well. It start at a very easy level, then moderate, and then it goes to difficult level. But understanding this is important so that you are comfortable over here. So coming back to our discussion now, Forex risk. Would someone like to guess what is Forex risk? Any guesses? Forex से risk होता है या नहीं?
There will be a risk involved.
There will be a risk involved, correct.
Exchange.
So due to exchange rate variations or fluctuations.
Perfect. Someone said
Fluctuations in exchange.
exchange rate change or fluctuation. Perfect. That drives your Forex risk. Now, how this Forex risk comes into picture? First, a transaction has to be a Forex transaction for this risk to exist. अब एक transaction Forex कब बनता है? It's very simple logic. See, let's say you are a business in India. There are only two verticals of transaction. Either a transaction will be revenue transaction, that money is coming inside the business, or it will be a cost transaction. Money is going outside the business. If it is in the same currency, if this is rupee, then this is not a Forex transaction. This is a domestic transaction. But even if one of them is in any other currency, then it becomes a Forex transaction. So let's take example of revenue as Forex transaction. If I am selling something outside my country, what should I call it? Should I call it import or export? We call it export. Perfect. Now, in this situation, whenever, let's say you are exporting something, let's create a scenario. I think putting numbers will be helpful. Let's say we sell something in the Indian market for 8,000 rupees. We are selling some kind of shirt in Indian market for 8,000 rupees. Now I want to export this. While exporting, I don't want to change price. Let's say I'm not interested in changing price. So what I will do, I will go to any bank or I'll go online and change the exchange rate. Let's say I'm exporting to US, United States. And the bank tells me that current exchange rate is for 80 rupees, $1, $1 USD dollar. So can someone help me? अगर $1 है 80 रुपीस के लिए, तो 8,000 के लिए कितने डॉलर्स रहेंगे?
$100.
$100. Is everyone getting this? Is there anyone who's not able to solve this? Cross multiplication है from our school days. Is everyone getting $100? Anyone who's struggling? No? ठीक. So the correct answer is $100. Yes. So while exporting, we will share an invoice saying that please pay us $100. Now, if this gentleman, whoever is in US, let me assume a volunteer's name. Let's say Sarita is based out of US and Sarita agrees. Okay, I'll pay you $100 immediately. Then there is no risk. Why no risk? Rate to वैसे का वैसे ही है. The rate has not changed. So there is no risk if Sarita pays immediately. But in this case, let's assume Sarita says that, let's say the business is run by me only. So Sarita says, Aditya, I won't pay you right now. Please give me the bill. I will pay you after 3 months. I will pay you after 3 months. Now, if Sarita is paying me after 3 months, in my revenue part, what should I write? I will simply write, I have accounts receivable of 8,000 rupees. And in bracket, I will write, I'm supposed to receive $100 worth of amount, but I'm expecting 8,000 rupees. Yahan tak, is everyone with me? Anyone facing any issue? No? Theek. In this period, the risk would be that the rate would change. In these 3 months, the rate would change. And this is nothing but your Forex risk. Now, how this risk gets reflected? Let's say ये जो rate है 80 का, this now comes down to 75. In these 3 months, the rate that was 80 rupees for a dollar now becomes 75 rupees for a dollar. And now, according to this logic, when we have given an invoice for $100, write it properly, for $1, we had given an invoice for $100. Guys, what is the amount we would receive?
7,500.
Perfect. 7,500. And now, once we receive 7,500, what is the amount we were supposed to earn? 8,000. Can you see a loss over here? Yes. This loss is of 500 rupees. We were supposed to receive 8,000. That's why we gave a bill of $100, but we ended up receiving 7,500. And this loss will be now allocated to our forex risk, forex losses. Forex risk. So this is how forex risk comes into picture, and not necessarily हमेशा risk होगा. Let's say 80 से अगर 85 होता, we would have received 500 more. But currently we are focusing on risk. So if you are now crystal clear with forex risk as a concept, can I get why in the chat? This is a tricky one, so let me take a proper vote. Okay, good amount of votes are coming in. Anyone having any doubts? The floor is open for discussion.
Sir, just a question. If the company maintains a foreign currency account, will it mitigate this forex risk? Means instead of taking in rupees, it takes in dollars only.
See, there are multiple ways to take care of this risk, and we'll be studying this eventually. We have a dedicated chapter on forex. But just to simplify or understand in a better way, what you're saying is, let's say in this case, I was running the business. Now, instead of keeping my business in local currency, you mean to say if I start selling in USD and if I start buying, means my cost is also in USD. Do you mean this, that this will eliminate? Or do you mean that you will just have a separate bank account where overall money will come in USD?
Yes, that's
Do you
what
mean
I meant.
this?
The second part, yeah.
No, you won't eliminate risk through this.
In
Reason
that.
being,
Okay.
at some point in time, you will either convert it into rupees because you're an Indian company, or the reporting requirement says if you're an Indian company, Indian GAAP through report kar rahe ho, you need to present everything in INR. Now, when you have
Okay.
something in USD and you are presenting it in INR, the rate that you will use should be current rate. No, you cannot use old rate. So the moment you use
Yes.
current rate, profit and loss will be there.
Okay, got it.
Yes. Okay. Chalo. Any other doubt? No? ठीक है, चलो. In that case, we can go back to slides. The risk that a transaction that is denominated, English is a bit off over here, denominated in a foreign currency will be impacted negatively by changes in the exchange rate. The same thing that we saw. The transaction currently was denominated in USD and the currency rate changed and it has negatively impacted us. 500 का loss हो गया. Now coming to unsystematic risk. Unsystematic nothing but your company specific or industry specific. Let's go to the subtypes. This is fairly easy, but let's do one thing. It's 3:23 right now. By the way, this is going to be a 3-hour class. ठीक है, 2 से 5 तक. But we usually take a break in between. So let's take our break, and I'll try to keep it light today. Today is your first class. So it's 3:23 right now. Why don't you guys come back by 3:40 p.m.? Consider this as a small tea or coffee break. Okay, 16-17 minutes. Freshen up, have tea, coffee. Come back fully fresh. We will start at sharp 3:40. Enjoy your break. So welcome back. Before we start, let's have a quick vote around your attendance. So this time, if you are there active, drop P in the chat. P for present. I'll get an idea that how many candidates are there in the class. I can see 18 participants. Okay, folks are still joining in. That is one candidate pending. Chalo, it's 3:41 though. We'll get started. Thank you, Sunil, Simran, Koho, Sarita, Rohit, Rishi. Okay, good to start. Chalo. So a quick recap of whatever we have studied till now. We started our discussion with understanding the relation between risk and return. We understood why high risk gives, delivers, asks for higher return or has to deliver higher return. After this, we focused on what is risk and we understood different types of risk. Within these types, we started with financial risk. Financial risk being of two types, we got unsystematic and then we got systematic. Guys, how can we go from unsystematic to systematic? Any guesses?
Diversify.
Perfect.
Diversify.
We can diversify. Now, within we looked at systematic risks first. So within this, we have looked at market risk. Would someone like to try these names? What all risks are there under systematic? There are 4 we have studied. Which is the second one?
Interest rate risk.
Interest rate risk.
Perfect. Interest rate risk.
Purchasing power risk.
Purchasing
Forex.
power
Forex.
risk.
Forex risk.
Forex. Inflation and then Forex. Perfect. Now we are starting with something called as unsystematic risk. The first risk we are going to look at is credit risk. Let me just check. Credit or liquidity, where are we starting? Credit risk. Now, credit risk is the easiest of all. I already took an example for this when we were discussing systematic and unsystematic. Let's say there is a business which has some amount that is borrowed. Now, whenever you borrow something, whenever you have a liability, it is a legal requirement to pay either interest, and whenever principal is due, you have to pay principal as well. So whenever you borrow something, whenever you have a liability, and the risk that you won't be able to pay back, the risk that you will default. Default means won't be able to pay, won't pay. This risk is called as credit risk. Even in our personal life, right? If you have a credit card, the risk that you won't pay your credit card bill, credit risk. You have a home loan, let's say a car loan, vehicle loan, jo bhi hai, you missed out on an EMI, becomes a credit risk. Now, the same topic or same concept in business context. When business takes a loan, business had some borrowings and they are not able to pay, becomes a default risk. Next, we have liquidity risk. Now, liquidity, the concept of liquidity means how liquid an asset is. How? I would say its ability to be converted into cash. Ability to be converted into cash. This is called liquidity. Now, in the world of finance, we have a clear bifurcation. If you are able to sell anything within 1 year, and secondly, when you are selling something, you are not facing a significant discount. Significant discount. If these 2 criteria are met, then we can call an asset as liquid asset. Liquid asset. Let me ask 2 examples to verify this. Let's say we have a production plant, and let's say we have some inventory of, let's say, vehicles, 2-wheeler bikes. two-wheeler bikes. If I talk about production plant, do you think this asset is a liquid asset or do you think this is an illiquid asset? What do you guys think?
Not a liquid asset.
Not a liquid asset. First criteria, if I decide to sell the production plant, can I sell it within 1 year or can I sell it within one production period, operating period? Operating period का discussion चलो बाद में करते हैं. But can I sell it within 1 year? The answer is no. See, production plant is a huge facility worth multiple crores. So if you have to sell it, it is very difficult to sell it within 1 year. Let's say there is a property worth 20 crores, huge facility. Now you want to sell this. Easy to sell within 1 crore? The answer is no. But imagine that a property with worth 20 crore, you decide to sell it at 7 crore. Do you think you'll be able to sell it within 1 year? Yes. All 50% से भी ज़्यादा discount है. I think line लग जाएगी. Within a day you will be able to sell. But the second criteria is getting violated. If the property is worth 20 crores and you are selling at 7 crore, significant discount or significant loss is actually the correct thing. Significant, you are selling this at a significant loss or significant discount. So when this criteria is getting violated, again, it is not a liquid asset. But think about some inventory of, let's say, bikes. Let's say you are working for TVS, you are selling Jupiter scooters. So can you sell a scooter, any given scooter within 1 year? Answer is yes, you can easily sell. When you have to sell, do you have to give some discount, significant discount, chota mota discount? I think retailers do give, shopkeepers do give. But is it a significant 30-40% discount? No. So in that case, when both criteria are met, I can call inventory as liquid asset and I can call production plant as illiquid asset. So now in terms of risk, where do we face liquidity risk? See, we need liquid assets, or rather we need cash to take care of our liabilities. Why we have to take care of liabilities? It's a legal requirement. वापस देना ही है कुछ भी करके. But within this liability also, there are two types of liabilities. One is current liability. Instead of current, let's call it short-term liability. Short-term liability. And second is non-current liability, or let's call it long-term liability. Current liability मतलब अरे अगले 1 साल में we have to pay back. So this becomes an urgent. It is important and it is urgent as well. So whole focus is over here. And when we have to take care of this current liability, the idea is, do we have enough liquid assets? Do we have enough current assets or do we have enough liquid assets to take care of current liabilities? If we have it, if our current assets, liquid assets, are more than current liability, we are liquid. We are in a good position to survive. But current assets are less than current liabilities. This is a difficult position. This is where we face our risk. Okay, we need more liquid assets to take care of payments. We have a shortage. So guys, clear with the idea of liquidity risk? Any doubts, any concerns? Okay. So the possibility that an investment cannot be sold, converted into cash for its market value. Liquidity risk is basically you won't be able to sell it at market value. If it's illiquid, then only you face risk. If it's liquid inventory here, you won't face this risk. Next is business risk. Now, business risk is actually an interesting one. The term is very vague, business risk, but the meaning is specific. Any venture, any entity would face business risk because of one fundamental economic factor. See, if any business operates, why is it able to operate successfully? One simple reason. If there is demand in the market for that specific business, or जो भी product service है उस business या for that specific product and service, the business will survive. And if there is no demand in the market, the business won't survive. So this risk of low demand. Now, how low demand or to what extent low demand? Here comes the conversion. If demand is greater than supply, you're fairly safe. You don't have much risk over here. Your business risk is low. But to be honest, there is one level of risk. If there is high demand in the market and the supply is low, there is some level of opportunity you are losing. Let's say there is demand for 10,000 movie tickets, but there are only seats enough for 5,000 viewers. वो बचा हुआ 5,000 का opportunity we are losing. So some level of risk is there, but yes, you are fairly safe when demand is greater than supply. Next, if demand is less than supply, supply ज़्यादा है, demand कम है, you are over supplying in the market. This is where actually you are in a tough zone, difficult zone, and over here your business risk is fairly high. There is a theoretical space. There is a theoretical space where there is no risk. Any guesses?
Demand is equal to supply.
Correct. Demand is equal to supply. This is called as equilibrium. Does equilibrium exist in real life?
No.
Very rare.
Correct. Very rare. Exactly. That's why, even though this is theoretical, and theoretically, there won't be any risk over here. Demand supply are at equal level. Now, this demand, this supply, its overall sensitivity, demand and supply को dictate कौन करता है? It is market price. It is the selling price that dictates demand and supply in the market. Going back to 11th and 12th standard ka economics or school level economics, I hope you guys are able to recall. If price goes up, demand comes down. If price goes down, demand goes up. It connects to those concepts. Okay. So coming back to the slide, let's have a quick overview. The variability of the firm's earnings, variability in terms of the revenue we are generating, this becomes business risk. Now, how this earnings fluctuates? Again, sales price, selling price, we just discussed. Business risk depends on many factors such as variability of demand over time, how demand changes over time. That will also define how revenue changes. Variability of sales over time. Again, it will define how sales changes or revenue changes. Variability of the price of inputs to the product over time. Now, what are these price of inputs? Continuing with our example, let's say we are selling Jupiter as a scooter in the market. Now, whenever I want to sell this, there will be certain selling price and there will be certain cost we will incur. Cost we will incur for what? We need raw material. We will have certain laborers, so direct labor, and we will have some factory level cost, rent ho gaya, overheads ho gaya, jo bhi. This cost will be part of our overall cost mechanism, and this is where we sell. Now, imagine that suddenly the price of raw material goes up. Suddenly, labor union asks for higher salaries. What will happen? It will take a hit on your profitability. This is also a risk. So this is nothing but when we say variability of the price of inputs, these are your inputs. You are selling a vehicle, engine is your input. The plastic mold is your input. Accessories, mirror वगैरह हो गया, seat cover हो गया. These are your inputs. And when the price changes, of course, it's a risk for you. And lastly, we have degree of operating leverage that the firm has. Now we will discuss in depth operating leverage later on. There is a specific section on ratio analysis. वहाँ पर we will discuss in depth. But I want to give you an example so that you have basic understanding of what is leverage. Let me take a new volunteer this time. Let me ask Rishi to step in. Rishi, imagine that you have 2 offer letters with you to become a CEO. Company 1, company's name is called, let's say, Universal Cabs. Universal Cabs. The model of this company is very simple. There are 50 cabs they have bought already. There are 50 cabs they're planning to purchase next year. And all these cabs will be put on driving assistance, mobility service, जो Ola Uber करते हैं basically. Driving service. Company 2 is called Faber. Faber नाम की actually company है. I'm thinking of a tweak to Uber. Let's call it Uber only. Assumption. अंडर उबर द मॉडल इज क्वाइट क्लियर. यू आर अ टेक कंपनी. आपके पास एक फोन एप्लीकेशन है दैट कनेक्ट्स cab drivers who have their own cabs, by the way, and there are passengers who want to travel. So again, this is a mobility service company that facilitates cab service. Which company you would like to work for, Rishi? Uber या Universal Cabs?
दोनों लाइक बोथ द कंपनीज का जो काम है वो सेम ही है.
काम सेम है अलग है, that's up to you. Observe. चलो, I'll make it easy for you. ये purchase वाला मैं हटा देता हूँ. Maybe this will help. Let's say you have 50 cabs on rent now. You have to pay a specific rent every month for 50 cabs. यहाँ पर you just have an IT application. आपका बस एक फोन में एप्लीकेशन है. There is no rent, there is no purchase, nothing. You just take commission. There is a price charge to cab और उसमें से certain commission comes to you. Which company you would like to work for?
C2.
C2. Reason?
लाइक जिसमें कोई हमारा फिक्स रेंट नहीं जाएगा ना. लाइक ओवरहेड्स हमारे बहुत कम आएंगे.
Correct. Spot on. This fixed component is nothing but leverage. Whenever a company has fixed cost, say in this case, when if I talk about universal cabs, there is a rent of 50 cabs. If we don't pay that rent tomorrow, default risk, right? We can get into trouble. यहाँ पर there's hardly any fixed cost. Fixed cost is extremely low. So at an operating level, whenever you see fixed cost being higher, it is called as operating leverage being higher. Leverage being higher. And whenever your fixed cost is low, it simply means that operating leverage is also low. Now, what is its impact? What is profitable? What is less, more profitable, less profitable? We will study that later on. But I hope the meaning of operating leverage is clear. It is the fixed component in your overall income statement. Next, we have industry-specific risk. So a risk that impacts one specific industry, that becomes industry-specific risk. If I had to give you a very classic example of this, around 4 years ago, European Union passed a rule saying that all electronic devices will have same charging port, C-type port. Now, for all the companies who had A-type ports, all the companies who had D-type ports, all the companies who had this, this type of ports, they all faced this risk. Everyone had to transition all their products to C-type. So this was an industry-specific risk. Why? The whole electronics industry had to adapt to this. So next is political risk. Now, political risk has actually been removed from your textbook. So safer side, I'll also not cover this. In different section, there is one section on risk management, specifically section 2. तब हम थोड़ा discuss करेंगे. But I haven't seen, I've asking questions around, is political risk being checked or not? And till now, I haven't heard anything. So this is something that is not being picked up right now. So we'll also drop it. This brings us to the overall discussion of types of risk. We have systematic risk, we have unsystematic risk. Next is return. Now, return में there are 3 simple calculations we'll be doing today. Once these calculations are done, then we are done for the day. But उससे पहले, I want to check your knowledge around percentages as a concept. So let me ask you guys a very simple question. Imagine that there is a company called ABC. In 2020, their revenue was $100. In 2021, their revenue is $120. Can you guys tell me by what percentage, what is the percentage growth this company has achieved in 1 year?
20%.
20%. Okay. Now, can you guys tell me how to calculate this? Any volunteer?
120
New minus old divided by old
100
into 100.
divided by
Old one.
Okay, one at a time. Muskan, can you repeat? You were saying something.
Yeah, so I was saying it will be 120 minus 100 divided by 100 into 100.
Okay, perfect. Now let me give some context to this. Whenever you are calculating percentage growth, the formula looks like this. You always start with the new value or updated value. New value minus the old value, and then you have to take the base. ये आपने change cover कर लिया, but change from what point? Your base point, which is also the old value. But we need this answer in percentage terms. ये percentage कहाँ से आता है? Percentage means in proportion to 100. This 100, 100 is now being defined as 1 is slanted, 0, 0. So in percentage to 100, we will multiply by 100. So following this is how the formula looks like. New value, 2021 new value. So 120 minus 100 divided by 100 multiplied by 100. If I solve this, it will be 20 upon 100 into 100. Get rid of this. Your answer is 20%. Okay. So I hope the first level of understanding is clear. 8th standard concept. Anyone who has doubt in this, I'm more than happy to repeat or simplify. Anyone having any doubt? No? Now next, very important rule. Achha, let me ask this in a question format. If there is company A and if there is company B, let's say Muskan decided to invest. Muskan invested in company A for 3 months and she got a return of 12%. Again, same investor invested in company B for 4 months, generated a return of 15%. Can you guys tell me which opportunity or which investment is better for Muskan? Muskan, why don't you try? Which investment turned out to be better for you?
So B,
B. And what is the reason?
I mean, like it's 15%.
But time won't have significance. Chalo, let me give you an extreme example. You invested for 1 month and you got 10%. You invested for 5 years, you got 12% return. Now, would you say 5-year ka investment is better? I'll also simplify. $100 डाले, you got back 112 after 5 years. यहाँ पर $100 डाले अपने investment में, you got 110 in 1 month. Do you still think 5 years ka investment is better in that case?
No.
So this is a classic case in terms of comparative analysis. Comparative analysis means you have two numbers to be compared. And a solution to this is already established. In the world of finance, it is mandatory, it is compulsory that whenever a return is quoted मतलब लिखा जाता है, mention किया जाता है. Whenever a return is mentioned, it has to be in terms of per annum. It has to be in terms of per annum. So whenever in your exam, you will get a question around, calculate rate of return. And there is some investment for 3 months, some investment for 4 months. Your answer wouldn't end over here. 3 months mein 12% hai, you will convert that into 1 year. And conversion is very simple. I'll tell you how it is done. You will simply write 3 months ke liye your return is 12%. So 12 months ke liye kitna? Do cross multiplication. Cross multiplication कैसे? X 12 into 12 upon 3. ये हो जाएगा 48%. Muskan, clear with the concept?
Yes, sir.
So now can you solve and help me with answer for this? If you are making 15% in 4 months, in 12 months, 12 months is basically 1 year, per annum is 1 year. 12 months mein kitna?
45%.
What would be your answer? Or
45.
anyone, not just Muskan.
45.
45.
45%? 45% per annum. And now we can compare. This return is also on yearly basis. This return is also on yearly basis. And now I can confidently say company A is a better investment opportunity, or it delivered better returns. So guys, clear with the concept of time adjustment? All good?
Yes, sir.
Yes. Okay. Chalo, in that case, I'll just ask you guys to write down a formula, then we can start solving. Your return or your profit, rate of return, is expressed as percentage of the principal amount invested. Depends on 3 factors: amount invested, length of time, how much time you have invested, and lastly we calculate rate of return from that. Please make a note of this formula in your exams. You will get investment and return up to 1 year only. So we need not worry about multi-year return. But for this, please focus on 1 year return. Drop a Y in the chat once you're done writing. And I want to give you guys a hint. Hint ke alawa, rather, let me call it foreshadowing. Again, this word is very important. Average balance of amount. Why are we writing average and not just base value, origin value, or old value or principal value? We are writing average over here. This has to do with time adjustment. A small hint for upcoming questions. So let's continue. I mean, they have broken down the definition of return. So return is the additional amount, additional profit that you earn. Means you have invested 100 and you have received 120. So इसमें से जो 20 part है, that is your return. That's it. So let's do the first question and let's see how many of you are able to get the answer. I'll read out the question, then you guys can start solving. Share your answers in the chat box. An investor invests $10,000 for 1 year and earns a $500 return on the investment. At the end of 1 year, the investor receives back 10,500. Return itna hai to 10,500 aega. What is the investor's rate of return? So today we invested. I'm writing minus because cash outflow we are investing, and at T1 we are getting back 10,500. Can you guys tell me what is rate of return? Sanampreet, Sunil, good. That was quick. Sarita, Saru, Kuldeep, Zed. Correct. Most of you are giving me answers. Jyoti, spot on. Sumit. ठीक है. Good. Komal, Simran. You guys are getting it. So the correct answer is 5% per annum. That's the rate of return. Now this is very easy. Okay. ऐसे questions नहीं आएंगे. Let's move to somewhat more tricky side of questions. If our investor invests $10,000 for only 6 months and earns $250, so basically out of this 1 year, T0 to T1, we invested 10,000 and after 6 months only, so T 0.5 or 6 months, anything is fine, we got back $250 as return and then 10,000 as our capital, initial principal. We received it after 6 months. Now can you tell me what is your rate of return? Guys, I have already told you, it is compulsory to mention rate of return in per annum basis. Some of you are giving me 6 months ka answer. That violates the rule. Correct, Kini. Prachi, spot on. Correct. What about others? Are you guys getting the answer? I mean, I can understand afternoon time. You guys might feel lazy to share your answers. But chalo, let me ask it in this way. Anyone who's struggling to solve this needs my help. Anyone who's not getting 5% as answer. किसी का 2.5 आ रहा है, किसी का, I don't know, 25 आ रहा है. Anyone? No? Okay. So chalo, there are two methods. Sanampreet, so answer would be 5% only. 2.5% is just not relevant. There are overall two types or two methods to solve this. We have method 1 and then we have method 2. Under method 1, we will follow our original method, which we discussed. I think there was example of Muskan, a number of months. We will use that method. So as per that method, just calculate your rate of return first. What's your rate of return? Our formula tells us rate of return is equal to the return that you have earned divided by invested amount multiplied by 100 for percentage conversion. And this will come out to be 2.5%. But this is only first part of your answer, because this answer is relevant for, they have mentioned in the question, 6 months. So step number 2 is going to be 6 months के लिए 2.5%, तो 12 months के लिए कितना? Cross multiplication. And over here, your answer will come out to be 5%. This is method 1. Now there is another method used by Hawk. Let me also give you clarity on that. So whenever you are reading Hawk, it shouldn't feel like something completely different. Hawk simply says that when we are investing for 6 months, we made $250. So imagine that we extend this investment for 1 complete year. 6 महीने में we made $250. So in another 6 months, we will also make $250. Assumption, we are just extending the overall return. So with this assumption, then your rate of return on an yearly basis, because now we have completed complete year, it is 250 plus 250, 500 upon 10,000 multiplied by 100, and this will come out to be 5%. So as per your preference, follow whichever method you like. I will recommend you method number 1. If you like method number 2, perfectly fine. This is the reason why they have done 250 into 2.
Sir, if the amount changes for the very first month and the very second 6 months.
No, but we have withdrawn now. Withdraw करने के बाद, it is all assumption. And assumption में the amount cannot change. The question says, you within 6 months $250 कमा रहे हो, you have $250. Now once you have $250 in your hand, return is received, then it is assumption. And assumption क्या? Whatever we did in first 6 months, repeat that in next 6 months. वही है. चलो. Now after this, we have somewhat tricky question. The type of question you will actually expect in your exam. If you are able to solve example 3, then your understanding of this concept is crystal clear. Okay, so chalo, all the best for question 3. Here's the question. I will read out the question, then you guys can solve it. Our investor invests $10,000 for 3 months. At T0, we invested $10,000, and this investment is continued for 3 months. T3M. Let's see what happens over here. Then withdraws $4,000 and leaves remaining $6,000 on deposit for another 3 months. Okay, so over here we have withdrawn $4,000. If we have withdrawn $4,000 from $10,000, guys, what is our balance? $6,000. Now for next 6 months, let me draw it like this. For next 6 months till T6M, we continued with this amount. At the end of 6 months, the investor withdraws remaining $6,000 along with income received of $200. So यहाँ पर we withdrew or we remove, withdrew is the correct word. Chalo, we withdrew our overall amount after 6 months. Over here, our balance is 0. But they mentioned that there is some return, additional return we have received. So this return we have received is of 200. And if you ever get confused with my signs, then let me be very specific. Inflow, outflow pay, ideally you should have signs. So I'll write it properly. When we invest, money goes out from us into the investment. So minus. Withdraw कर लिया है, so plus. Now we are withdrawing again, so minus. Sorry, we are withdrawing, so we are receiving the cash plus. Also, we are receiving the cash plus. So if you observe, minus sign, 10,000 invested, plus sign, money received at different point in time. The question is calculate rate of return. I'll be teaching you, I'll be giving you a shortcut as well. This is actually easy, but I want you guys to try first. So it's 418, take 2 to 3 minutes, take 5 minutes. We will start solving at 422. Let's see how many of you are able to do. No disturbance till 4:22. Kuldeep, you might consider trying again. Chalo, time's up. Is there anyone who wants me to wait? Someone who's on their last step? Chalo, for solving this, I'll take a volunteer who can help me out, and let me ask Kuldeep over here. So Kuldeep, going back to our formula, how is ROR calculated? We have written in the numerator, and what is in the our denominator? Actually, you have a problem with your mic, not an issue. So there is average investment that comes in the denominator. Now the problem is, if you are investing for the complete year, average is very easy. But when you are investing in bits and pieces, then we have to separately calculate an average. Separately calculate an average. So यहाँ पे there are two ways you can consider. First is you can consider 6 month का period. Take average based on 6 months, and then once you have ROR, convert it into 12 months. Let's do that. So this is going to be your option one. Option one. ठीक है. I mean, in the numerator, you don't have to change anything. Now, in terms of 6 month period, for first 3 months, can someone tell me this? How much capital have we invested for first 3 months?
10,000.
10,000.
10,000. Perfect. But I'm considering overall period of 6 months only. So from 6 months perspective, for half of the period, for 3 months, I have invested 10,000. So an average amount over here will be 10,000 into, now this is a word that I have created, time adjustment factor. 10,000 into 3 months divided by 6 months. Out of 6 months, we have invested only for 3 months. So half of the period. So for this period, your average capital is going to be 10,000. See, 3 by 6 is 1 by 2. So this will be 5,000. 5,000. Now next, we have withdrawn some amount over here. I think 4,000, Sana?
Yes.
We have withdrawn 4,000 over here. So now can you tell me for this period, how much amount we have invested?
6,000.
Perfect. 6,000. But again, if I consider 6 month period, I have invested 6,000 into time adjustment factor, which is 6,000 into 3 divided by 6, which is 3,000. 1 by 2, 6,000 ka half, 3,000. So now I can say this is how my question looks like. My return overall is 200. 200. My return overall is 200. My average capital, weighted average, weight being the time that I'm writing directly. So average capital for first 3 months is 5,000. For next 3 months is 3,000. So my total capital is around 8,000. And now I can take a proportionate this thing percentage. My rate of return is equal to 200 upon 8,000 divided by 100. Guys, what is the answer coming out to be?
2.5%.
2.5%. Now, one last step. What was the overall period we have considered over here? Is it 6 months or is it 1 year? This is 6 months.
6 months.
So the
6
rate
months.
or the rate of return we have arrived at is for 6 months only. But the rule says we need per annum for 1 year. So now we will say 2.5% for 6 months. So 12 months ke liye kitna? It will be nothing but 5%, which is your answer. This is nothing but your answer. This is option number 1. Now I'll give you option number 2. Option 2. Consider overall period as 1 year period. T0, T3M, T6M, T9M, T12M. 1 year. Now in this period, first 3 months, 10,000. Next 3 months, 6,000. But now while taking weight, this is 3 months in comparison to 12 months. So यहाँ पर weight हो जाएगा 10,000 into 3M divided by 12M. I'm considering 1 year now. So the answer would be 1 by 4th. This will be 2,500. First part of your capital, average capital. Average will be 2,500. Next. 6,000 into another 3 months out of overall 12 months. This calculation will come out to be, I think, 1,500. 1 by 4, 15. Correct. 1,500. This is second part of your capital. Average capital over here is 1,500. Now we have already considered complete year, so no further adjustment required. Just put the numbers into your formula, you will get the answer. So now the formula is rate of return is equal to return upon average capital. Return is 200, capital 1, 2,500, capital 2, 1,500 into 100 for percentage conversion. 200 upon 4,000. Guys, what is the answer? 5%. So this is your option number 2. You can directly consider whole year and you will get 5%. That's it. So chalo, let me take a final vote on this. If you guys are crystal clear with all three questions, first one is rate of return adjusted for full year, and investment in proportionate rate, and then rate of return for the full year. If you are crystal clear with this, please help me with a Y in the chat. That's it for today. Okay, I have 14, 15, 16. I have 80% votes. No problem. I can assume less remaining 10, 20% are feeling lazy today. Actually, there is only one slide pending. Let me just cover one slide, then we'll call it a day. CAPM से हम कल start कर सकते हैं. See, in the world of corporate finance, if we talk about risk and return relationship, there is a specific range of products according to which your risk and return changes. Now, if I had to ask you, which is the product where you could invest and you will have minimum possible risk or almost no risk, where would you invest?
Government bonds.
Correct. Government bonds or any government backed bank also will do. Now, when we are investing in government bonds or any entity of government, why is there a safety net? What do you guys think? What would be reason behind it?
Low risk, low return.
No, low risk, low return, I agree with you. But risk low क्यों है government bonds में? What kind of magic government has that makes them low risk?
Maybe they're not that aggressive, maybe when it comes to the policy making.
They are aggressive. We have examples of Zimbabwe became very aggressive, eventually got into hyperinflation and
Less
economic.
fluctuations.
Sorry, Rishi, can you repeat?
Less like no fluctuation there.
No fluctuation. No, I wouldn't still agree. See, the main
Always,
reason
they always
behind
pay because they are the one printing the currencies.
They have reserves.
spot on, spot on. No more than reserves. You can always run out of reserves, but you can always print more money. So I don't know who said that, but spot on. That is the correct answer. You can always print money. You can always print money and pay it back. So that's why you're assumed to be risk free. Okay, the rate that you quote is risk free rate, but it's an assumption. Okay, governments can default and have defaulted. Zimbabwe being one of the classic examples. But now, after government bonds, if we had to, let's say, highlight which is the next. So, US Treasury bonds are US government bonds. Next, which are fairly, bit more risky, but not very high risk. It is first mortgage bonds. First mortgage bonds. So, first mortgage bonds are actually issued by companies. But what does this mortgage mean? Mortgage simply means that keeping certain level of collateral as security, keeping certain or pledging certain collateral as security. Imagine that tomorrow Reliance wants certain loan, but SBI thinks Reliance is very risky, so we can't give them loan as it is. So Reliance says that I have certain machinery or I have certain land in Gujarat somewhere. I will keep this as mortgage. If I don't pay, you can sell this and recover money. Now, when a mortgage is kept, it becomes fairly low in terms of risk. So, guys, clear with the concept of first mortgage bonds? What are first mortgage bonds? These are secured bonds. BCom में इसे secured bonds कहते हैं.
So is it similar to debentures?
हाँ, bonds and debentures are one and the same thing.
Oh.
Yes. Okay. Now moving ahead. After first mortgage bonds, we have something called as subordinated bonds. Subordinated bonds. This is where things actually get interesting. Again, these are issued by companies. But this time what Reliance will say that, see this, the value of this property is extremely high. It's very expensive. If sold in the market, you can get multiple crores for it. SBI, let's say, has given a loan of 50 crores, but the value of this land is 200 crore, something like this. Okay. So there is a lot of value remaining in this. So what Reliance can do is, Reliance can again go to some other investors, issue a bond saying that I have a land that has huge value. Now on this land, I have taken first mortgage loan from SBI. Now after this, let's say they go to HDFC and they'll say that, Acha, in terms of HDFC, why don't you take second mortgage loan? So if I default tomorrow, if Reliance defaults tomorrow, SBI will recover their money, and from the leftover value, you can recover your money. So HDFC says, okay, we will give you loan of 30 crore. If tomorrow Reliance fails to pay, they will sell the land. SBI will be the first one. That's why it is called first mortgage. So SBI will first get their 50 crores, and then from the remaining amount, 30 crores will be paid to HDFC. So guys, clear with the idea of subordinated bond? Subordinate matlab junior bond, junior rights, secondary rights. This is second mortgage bond bhi kehte hain. But clear with the idea? Couple of yeses would do. Okay, thank you. So first mortgage is done, subordinated is done, second mortgage same. Then we have income bonds. Income bonds are simple unsecured bonds. What are unsecured bonds? Reliance says that, we are a good credible company. Please invest in us. Give like lend money to us, not invest. Or even when you are investing, not equity investment. This is kind of borrowing. Instead of taking loan from a bank, we can take loan from investors as well. So when you borrow without any collateral, without pledging any security, just on credibility basis, these are called as the bonds you issue, the contract that you sign. It is called as income bond. Best example of income bond is when you go to SBI and you do a fixed deposit. The deposit receipt that you get is nothing but your income bond. The bond is entitling you to give you certain income. Is there any collateral? No. The bank is not keeping any collateral with you. Is there any mortgage vagara? No. So this is income bond, simply giving you income. If you are someone who is very comfortable with your BCom terminologies, this is how you can remember. First, you have government or kind of treasury instruments, treasury bonds, debentures. After this, you have secured bonds. Secured bonds. Within secured bonds, we have two types. We have first mortgage, and then we have subordinated mortgage or second mortgage. After this, we have unsecured bonds. In unsecured bonds, we have income bonds. We have arrived till here. Then we have preferred stock, convertible preferred, and common stock. Let me explain what these are. This is something you will get to study in Finance 101 as well once you do your assignment. But this is how it looks. See, whenever an investor wants to invest in a company, there are usually two options. First, he can invest through debt. Debt matlab he can lend some money. Can lend some money from the business end. It is nothing but a borrowing. And in this, you will get certain amount of interest as your return. Let's say 7% interest you'll get as your return. There is another type. There is something called as equity investment as well. You are basically taking up ownership. And let's say under ownership, the risk is high. You commit a return through dividends or through value, increasing. IPO के लिए चला गया, stock price बढ़ेगा. Through that, you commit a return of, let's say, 20%. High risk, high return. यहाँ पर low risk, low return. It's a committed return. But let's say as an investor, you want something of moderate risk. This is extremely low. This is extremely high. You want moderate risk. So here comes another option called as preferred stocks. And there are two major features of preferred stock. As preferred stock, you are committed dividend. You get something called as committed dividend. Now, what is committed dividend? The condition is if the company is profitable, then the dividend payment becomes compulsory. But if there is no profit, you can skip the dividend payment. So in this case, dividend is not a liability, but it's a soft commitment. Profit hua to compulsory we will give you. Nahi hua, then let it be. Now there are certain terms, conditions, and overall we will study that later. Second major important feature is in terms of liquidation. Liquidation matlab let's say कल company बंद हो गई. बंद होने के बाद once you close down the company, you have to pay amount to all the stakeholders, all the owners, all the investors in certain chronology. First payment always goes to debt holders. Why? Because it is a liability, legal requirement. The second payment will go to preferred stock. That's why the word preferred, preference diya jayega inko. So when there is liquidation, when the company shuts down, these guys will be preferred over whom? Over common equity shareholders. Okay, this is all about preferred stock. Now I want to add one more point. See what happens, preferred stock usually come with certain maturity. they will issue it for 5 years, 7 years, 7 साल के बाद, they will pay dividend for 7 years if they are profitable, and then they will buy back the shares. But during this process, what happens? There are some investors who get FOMO. FOMO of what? Let's take an example. Do you guys know Boat as a company? Headphones का company है. पता है आपको? Do you guys know this?
Yes.
Variables? Yes.
Yes.
Yes, sir.
Now imagine that a boat company has approached you as an investor asking for some money as preferred shares. Now preferred shares usually don't get stake in the ownership. So tomorrow when boat goes for an IPO, public listing, and opens up at a very high price, all the common equity shareholders, the actual owners of the company, they will make a lot of money. But over here, if I talk about preferred shareholders, how do they make money? It is limited to the dividend committed to them. They will miss out on this. So such investors get FOMO, fear of missing out. So in that case, what they will do, they will add a clause in their contract while giving the money, while giving the investment. The clause will say these preferred shares are convertible, which means as per the agreed terms and conditions, the preferred shares can be converted into common equity shareholders, so that whenever these shares go for an IPO or whenever these shares are sold in the market, the preferred share investor can make a lot of money. These are called as preferred shares. Okay. Again, this is something that we will discuss in depth later on. And this brings us to the end of overall list of different investment opportunities you have in the market, from low risk to high risk. Common stock means you are the ultimate owner of the company, highest risk. आपके पास voting right भी रहते हैं, but you also have the highest amount of risk. Okay. Tomorrow we will study what is capital asset pricing model. Chalo. I hope you guys liked today's lecture. You guys understood what we have discussed.
Sir,
Let me help. Yes.
sir, preferred stockholders they also have a low risk because they get dividend only.
We can call it moderate risk. I wouldn't call it low risk or high risk. See, it is all about comparison then. If you are comparing with debt, these guys have high risk. If you are comparing with common equity shareholders, then these guys have low risk. Why low risk? Profit होने पे dividend तो guaranteed है. ऐसे. Okay. And that is the reason why you will also see when debt is giving 7%, interest is around 7%, equity owners are, let's say, getting around 20%. So the return preferred shareholders will be, let's say, somewhere around 15%. बीच में रहेगा. The risk is in between, the return will be in between as well. Always remember, the return on debt is always the lowest. उससे ज़्यादा रहेगा return on preferred shares, because the risk increases, and उससे ज़्यादा रहेगा return on common equity shareholders. Rachit, does that help?
Yes, sir.
Okay, no problem. Chalo, in terms of your assignment, few pages to be read and few MCQs to be solved. Please note this down. Whenever I'm sharing my screen, ये website थोड़ा slow हो जाता है. Please bear with me. From the MCQ segment, first chapter, financial risk and return, I want you guys to solve 10 questions. Okay. This is first part of your assignment. Second, from your textbook, I want you to read the whole first unit. I'll just highlight page numbers. Let me write over here, assignment. So you got MCQs 10 from financial risk and return. You got finance 101. ये सबसे पहले करना, finance 101 first. All lectures plus simple mathematics, all lectures. After that, come to reading and then do the MCQs. Okay, this is how the chronology should be. Let me stop sharing. तब ये load होगा अच्छे से. Okay. Please take a note of page number. Your reading starts from section B, page number 113. From 113, go all the way till 119, 119. You have to read unit 1 from section B. Complete unit 1. Okay. That's it, guys. If you have any queries, concerns, feel free to ask. Else, the class is done. Thank you. Enjoy the rest of the Saturday. I'll see you tomorrow morning.
Okay, bye. Thank you.
No problem.
Thank you, sir.
Thank you.
Thank you.
Thank you,
Thank you.
sir.
Thank you, sir.
Thank you.